Look, in every single market cycle, we see the exact same thing happen. Thousands of people literally lose their life savings. Portfolios just bleed out. Panic spreads like a virus, right? You turn on the news, and it's just endless doom and gloom. But here's the crazy part. Right in the middle of all that terror, a completely new generation of millionaires is being quietly minted. This right here, this is the alchemy of the market. The raw, unfiltered reality of how true wealth is constructed while the rest of the world is just paralyzed by fear. So it brings up this massive, enduring mystery. How on earth does the exact same market create absolute fear for some people, but life-changing wealth for others? I mean, history shows us this inescapable pattern. Think back to the dot-com crash in the early 2000s. Trillions just wiped out. Or the brutal 2008 financial crisis that basically brought the global economy to its knees. And of course, the sudden COVID-19 crash that halted the whole world in a matter of days. Every single time, the life savings of the masses got decimated. Millions watched their financial security just vanish. But these exact same events were the ultimate breeding ground for new generational fortunes. So the core question really is, how is it possible that the exact same market creates sheer terror for the majority, but life-changing wealth for select few? Well, let's actually break down the anatomy of a market cycle. To really understand this massive wealth transfer, we gotta strip away the media hype and look at the actual mechanics. Every cycle begins with optimism. Fundamentals look stable, prices are slowly creeping up, and the public starts to take notice. But then, that quiet confidence inevitably metastasizes into pure euphoria. Greed just takes over completely. Valuations get totally detached from reality because everyone's rushing in, convinced the upward trajectory is permanent. But you know how this ends. A catalyst hits, and we get a correction. Prices start to drop. What starts as, hey, let's just be cautious, rapidly spirals into full-blown panic. Aggressive, indiscriminate selling takes hold, because investors are just scrambling to salvage whatever cash they can. It is only after the dust settles and the weakest hands are completely shaken out that the long, quiet process of recovery finally begins. This sequence isn't accidental, by the way. It's completely inevitable. Because at the end of the day, the market cycle is not a bug. It's a feature of human psychology. It's a fundamental mistake to look at the stock market like it's this perfectly rational, calculating machine. It's not. It is a mirror reflecting our own human irrationality. These cycles of boom and bust, they're driven entirely by collective emotion. Markets move on expectations, swinging wildly like a pendulum, from absolute, unbridled greed to sheer terror. And half the time, it's totally disconnected from what's actually happening in the economy right then. This is a fatal systemic flaw in human nature, and the market ruthlessly exploits it. And that leads us right into the trap of human psychology. Since these cycles are so predictable, you have to ask, why do regular, hardworking investors keep losing money? Well, our brains are literally hardwired to be terrible at investing. On one side of the behavioral spectrum, you've got this intense herd instinct. People naturally want to buy when everyone else is buying. During periods of high prices and euphoria, they feel this false sense of invincibility. The fear of missing out completely overrides any sense of risk. But then, on the flip side, when the market tanks and uncertainty is at its absolute peak, our primal survival instincts kick into overdrive. The news cycle turns incredibly negative, your portfolio is bleeding red, and your brain is just screaming for safety. This intense psychological pressure forces individuals to liquidate their assets at the absolute worst possible time. They literally buy confidence and they sell fear. It is a stark reality, but it practically guarantees permanent wealth destruction for the average investor. Think about it. The exact same businesses they eagerly bought at premium prices suddenly feel existentially dangerous to them when they go on sale at a heavy discount. By letting their emotions run the show, they turn what should be a temporary, totally normal market dip into a permanent, devastating financial loss. But here's where we find the hidden opportunity in the panic. For a highly specific type of investor, a market crash isn't a catastrophe at all. It's a rare, monumental opportunity. Just look back at the depths of the 2008 financial crisis or the total paralysis of the COVID crash. Deep, terrifying uncertainty gripped the entire globe. But beneath all that panic, a profound mispricing was happening. In what we call a liquidity crisis, terrified investors are forced to sell everything they own just to raise cash.
And because of that, world-class, high-quality businesses, companies with impenetrable balance sheets and massive cash flows, they get dumped onto the market at steep temporary discounts. The panic basically blindly discounts the greatest assets in the world.
That is exactly why future millionaires are created during periods of uncertainty. Generational wealth is almost never forged during the loud, flashy excitement of a bull market. No, it's quietly constructed in the terrifying depths of a panic. But doing this requires a profound level of psychological detachment. When the masses are fleeing the market in sheer terror, dumping their quality assets just to salvage whatever capital they have left, the prepared investor is stepping directly into that bleeding market, acquiring equity in world-building companies for literally pennies on the dollar.
This whole mechanism is what I call the ultimate wealth transfer.
Now, capitalizing on these crashes doesn't require you to have Wall Street insider knowledge or complex algorithms, and it definitely doesn't require the illusion of perfect timing. Successful long-term investors don't waste their energy trying to perfectly predict the exact market bottom, the absolute top, or exactly when the next crash will hit. Predicting those movements is honestly a fool's errand. Even seasoned professionals get it wrong all the time. If you just sit on idle cash, waiting around for that elusive, perfect dip, you're almost guaranteed to miss out on years of compounding growth. Timing the market is an impossible trap, and it keeps amateur investors permanently on the sidelines.
As the saying goes, time in the market usually beats trying to time the market. The real secret to capturing the market's long-term upside isn't about prediction at all. It's about emotional survival. When your portfolio is down 40% and the daily news is broadcasting the end of the financial world, your technical analysis doesn't mean a thing. What actually matters is discipline. It's having the stoicism to stay fully invested right through the panic, allowing the relentless math of compounding to do its heavy lifting over the course of decades. At its core, a market cycle is a pretty ruthless machine. It functions systemically to transfer wealth straight away from the impatient, emotional folks making short-term moves directly into the hands of the patient, disciplined investors thinking long-term. The market actively punishes anxiety and it rewards stoicism. It literally drains capital from people obsessed with the adrenaline of short-term excitement, and it redirects it to those silently committed to holding long-term value. Because ultimately, the market rewards behavior way more than intelligence. Raw intellect does not guarantee financial survival. Actually, a lot of really high IQ individuals get absolutely crushed in the markets because all their complex analysis can't override their primal biological fear. True psychological resilience, having the iron discipline to control your greed during the euphoric, dangerous highs, and the courage to conquer your terror during the devastating lows, that is the definitive metric of success. Just remember, opportunities often wear the disguise of uncertainty, and make no mistake, the next inevitable market crash is already approaching. We don't know the exact date, but when it finally arrives, the headlines are going to be dramatic, the narrative will feel totally unprecedented, and the panic will feel uniquely terrifying. But beneath all that noise, the fundamental architecture of the cycle is going to be exactly the same. The question is no longer whether the next cycle is coming. The only reality that matters is, how are you going to behave when it finally does?